This video is on the biggest investing mistake. So I wanted to make a video about this because this is a mistake that I hear people make all the time. And what's crazy is that people making this mistake should know better. I talk with a lot of people about finance, and some people I hear making this mistake is, I hear it from accountants, I hear it from business students, I hear it from business owners, I hear it from executives, and so it's a pretty common mistake. And it really has to do with just an understanding of the nature of investing, the very fundamental nature of investing. And so I just would like to talk about this a little bit in this video. But before we jump right into the mistake, what I'd like to do is start with a more tangible example. Sometimes financial concepts are difficult to wrap your head around, so I want to start with an example that most people have experience with, and that is purchasing a used car. So let's say you go out and you purchase a used car, and you're very happy with your purchase. You're so happy that you take your car out, you go over to your friend's house and you say, "Man, look at this used car that I purchased. I got such a great price. I got such a great deal. This used car was a really great purchase." So that's the example of the used car purchase. And the question that I want to pose on this example is, what do you mean when you make the statement, "I got a great deal"? What does that really mean? And what I want to suggest is, what you're really saying there is you're saying, in this purchase of the used car, I took advantage of a mispricing in the market. Because what really happened is, you bought a particular car with a certain set of characteristics. And there's other cars out in the used car market with similar characteristics. You could go down the street to a used car lot and buy a similar car at a different price. But by you acknowledging that you got a great deal on this car, what you're really saying is, compared to similar cars in the market, on this purchase, I got a lower price than what other cars are selling at. And in that framework, I took advantage of a mispricing in the market. I bought this car that was undervalued. And to take it a step further, you're really saying that you made an instantaneous profit. Because if you bought a car that was undervalued, that suggests that you could go out into the market the very next day, put this car up for sale, sell it to somebody else for a price that similar cars are selling it at the market, and make a profit from what you bought it for. So that simple statement, "I got a great deal," actually has a lot going on in it. And I suggest that it means you're taking advantage of a mispricing in the market. So let's bring this back to investing and the mistake that I'm talking about. And the mistake is how people are talking about their investments and thinking through their investment decisions. And, I'll have conversations with people and they'll go something like this. They'll come to me and they'll say, "Man, I'm so excited about this stock purchase I just made. I bought this stock, I found this great company. This company has strong financial standing. It's growing every year. Its revenues are increasing every year. It's making a ton of profits. This company is going to make so much money, and now that I own stock in that company, that money is going to flow through to me through that stock." So that is the mistake. And the mistake is that that's an incomplete argument when you're talking about investing. And just to define this further, I'm going to throw up a definition of what I'm talking about. The mistake is this. It's the failure to separate two distinct concepts. And the concepts are the quality of a company and the attractiveness of the stock price. And these are two distinct concepts. And the idea is that the statement that that person made about how this is such a great company, that's talking about the first concept, the quality of a company. And that's an important concept to understand. But there's also a second concept going on implied in every purchase. And that concept is, what is the attractiveness of the price? Is this stock overvalued? Is it undervalued? Or is it appropriately valued? And here's why this is important. Because you can buy the stock of the greatest company in the world. I mean, this could be an amazing company, and it doesn't really matter if you buy the stock at a bad price. If you buy the stock when it's overpriced, that stock is eventually going to correct, and you're going to lose money. So it's helpful to understand this as two separate concepts. And to bring this back to the example we discussed earlier about the used car, what you're talking about when you say, I got a great deal, you're really talking more about this mispricing in the market. That's what you want to get a better understanding of. You know, what you really want to be able to do is purchase the stock that's undervalued for a great company, because then when the stock market corrects, you're going to make a return on your investment. And that's really what you should be saying in these statements. You should be saying something like, man, I just bought the stock of a great company. And I also identified a mispricing in the market, that when the market corrects, I'm going to make a return on my investment. So, you know, I want to be clear here. You know, I'm not giving any investment advice in this video. I'm not even suggesting you should invest at all. What I'm trying to do here is expand your understanding of the financial decision-making process. And this is going to go into some of the other financial models that we're going to talk about in some of these videos. But if you can get better at this investment decision-making process and separating out these two concepts when you make these decisions, you're going to make better investment decisions. You're going to make better financial decisions. You're going to make better business decisions. And that's really what this is all about. Being able to look at a market and not only identify what the good companies are, but being able to identify what is the stock price telling us about these companies. Are any of these stock prices mispriced? And can I take advantage of that mispricing? So, you know, this is a pretty complex concept, and we're going to talk more about this in the next video, where we talk about market pricing. But just to recap, we started by talking through an example of a used car purchase and how that relates to taking advantage of mispricing in the market. And then I gave an example of the biggest investing mistake and defined it and explained why it's important to understand the very nature of investing.